Good morning, everyone. I'm Mike Quaranta, President of the Delaware State Chamber of Commerce, and we're excited to once again have Philadelphia Federal Reserve Bank President Patrick Harker with us again today to talk about the economy in general and things in our region and some specific Delaware industries and how we're doing. And so without any further ado, let me invite Pat to make some opening comments and share some thoughts, and then we'll come back to some questions. And if you're interested in asking a question, I've got a number of questions in front of me, but you're welcome to put those in the chat. And if we've got some time towards the end of his presentation this hour, we'll certainly try to get to those. So Pat, take it away.
Thanks, Mike, and thanks so much for having me. Good morning, everyone. It's great to be here with the Delaware State Chamber of Commerce. Thanks for having me for what has become really an annual opportunity to get together, even if just virtually. And to each of you with us, thanks for allowing me to be part of your Friday, particularly your Friday morning after a Phillies win. And yes, I am wearing the Phillies tie today. So I know we have a lot of ground to cover and only an hour in which to do it. And as much as I enjoy providing you with my outlook, I much more enjoy the ability to drill deeper into issues through a conversation. So let's just get right into this. So of course, I must begin with the standard Fed disclaimer. The views I express today are my own and do not necessarily reflect those of anyone else on the Federal Open Market Committee or in the Federal Reserve System. Or, as I've become fond of saying, when you're telling your colleagues about this morning's conversation, you can say Pat said, not the Fed said. Okay. Now, as you can imagine, the two topics I get asked about most are interest rates and inflation. And I know when we start to talk about those two, that they are our dual mandate, and they're very, very important to us to make sure that we keep those front and center all the time in our mind. And so let's think about where we are with respect to those two. And think about those particularly, not just with respect to the overall economy, but really how they affect businesses and families all throughout the country. So let me start there. Let me start where we are. After the last policy hike in July, I went on record with my view that if financial conditions evolved roughly as I expected, we could hold rates steady, hold them where they are. While I have been proven wrong in less than 2 months before, I am happy to say that so far, economic and financial conditions are evolving as I expected, if not perhaps even a tad better. Disinflation is underway. Economic activity has been resilient. Labor markets are coming into better balance. Moreover, these conditions aren't just where I see in the national economy being, but also our regional economy, and specifically for today's discussion, Delaware's. And I'll note those points in turn. So I remain today where I first announced myself in early August. Absent a stark turn in what I see in the data and hear from contacts, both in one-on-one conversations and in forums like this, I believe that we are at the point where we can hold rates where they are. Look, we did a lot, we did it very fast. In barely more than a year, we increased the policy rate by more than 5 percentage points and to its highest level in more than 2 decades, 11 rate hikes in the span of 12 meetings prior to September. But, we also turned around our balance sheet policy, and we turned it around fast, and we continue to tighten financial conditions by shrinking the balance sheet. But the workings of the economy cannot be rushed, and it will take some time for the full impact of higher rates to be felt. Holding rates steady will let monetary policy do its work, and I am sure rates are restrictive. And as long as they remain so, we will steadily press down on inflation and bring markets into a better balance. By doing nothing, we are still doing something. And actually, we are doing quite a lot. We are also giving ourselves a chance to navigate some of the current uncertainty. Labor strikes, oil prices, and the not fully exercised specter of a government shutdown included. I am more and more confident that not only is monetary policy currently working, but it will continue to work. Headline PCE inflation remains elevated in August at 3.5% year over year, but it is down 3 percentage points from this time last year. Now, half of that drop is due to the volatile components of energy and food. So despite both those being basic necessities of life, economists typically exclude them from the so-called core inflation rate, which gives a more accurate assessment of the pace of disinflation and its likely path forward. Well, core PCE inflation has also shown clear signs of progress, and the August monthly reading was its smallest month-over-month increase since 2020. So yes, I do see a steady disinflation underway. It's not going to be a straight line, though, and I expect it to continue, with inflation dropping below 3% in 2024 and leveling out at our 2% target thereafter. However, there can be challenges in assessing the trends in disinflation. For example, yesterday's release of September's CPI report came out modestly on the upside, driven by energy and housing. But I think, let me be clear about two things. First, we will not tolerate a reacceleration in prices. But second, I don't want to overreact to the normal month-to-month variability of prices. And for all the fancy techniques, the best way to separate a signal from noise remains the average data over several months, not just look at any one particular month. Of course, to do so, you need several months of data to start with, which in turn demands that, yes, we remain data dependent, but patient and cautious with the data. Meanwhile, I continue to see GDP growth that is outperforming estimates from earlier this year. This economy is proving to be nothing if not resilient. I don't expect GDP gains to continue through the end of 2023, but I do expect those to continue through 2023 before pulling back slightly in 2024. But even as I foresee the rate of GDP growth moderating, I don't see it contracting. In other words, I don't anticipate a recession. So let's turn to Delaware. In Delaware, the signals point in the same forward direction. And in fact, business formation in Delaware, including for high propensity businesses, remains strong, having risen continually since the pandemic. Delaware's coincident index, the Philadelphia Fed's summary, it's our summary metric of economic activity, increased 3.3% year over year, according to August data, reflecting generally positive conditions. And in fact, Delaware's 3-month increase of 0.6% matched the national rate of increase. In the Philadelphia Fed's most recent business outlook surveys, the survey manufacturing and non-manufacturing firms, we do this throughout the 3rd district, including Delaware, firms overall reported declines in the current month, but their 6-month outlooks are optimistic for growth. Now, recognizing the importance of tourism in Delaware, I do note that the number of summer overnight tourist stays captured by the Rehoboth Beach, Dewey Beach Chamber of Commerce showed accommodation room counts down from last year's high levels between Memorial Day through Labor Day. However, we know that there's probably much influencing these numbers beyond inflation or other economic factors, including, of course, the weather. All this aside, I fully recognize and appreciate these challenges, the challenges that monetary policy is presenting to you and your businesses. These are outside factors, factors that bring uncertainty with them, which continue to parallel the more restrictive stance we have pursued through the FOMC. For example, while we are now 6 months past the spring banking turmoil, the impact of that episode on credit markets is still being felt. This is not new to many of you, I know that. Our contacts throughout the banking sector continue to report tighter credit conditions, which essentially have the impact of higher rates without requiring them to be so. Now, as I've spoken with contacts throughout the 3rd district this summer, I heard from across industry sectors the challenges presented by both rates and current conditions in terms of access to capital, from banking to retail to agriculture, manufacturing, and everyone in between. And I know the impact of the current climate is also having in the residential real estate sector, a real impact, as higher mortgage rates have constricted inventory, which has in turn led to increasing prices and a shallowing of the pool of prospective buyers, not just in Delaware, but throughout the region and the nation. Let's turn to consumer finance. And consumer finance, which I know is a particularly important sector for Delaware, there's data that we follow closely. So we do take note that while the number of open bank card accounts is up nearly 6% year over year, the rate of growth in originations is down during the same time span through June, according to the latest available data. And we do pay attention to the fact that outstanding balances are up more than 15% year over year as of August, while more consumers are pushing their payments forward, as evidenced by both the nearly 6% increase in the number of outstanding accounts and the increase in delinquency rates. And in Delaware, the 30-day delinquency rate in mortgages has been trending upward and now exceeds pre-pandemic levels, 2.4% of active loans today versus 2.2% in February 2020. Additionally, the current turmoil in labor markets is likely to similarly exert downward pressure on activity. I would say this is perhaps the most notable among the auto workers' strike, given the enormous impact of that industry on our overall economy. It's an industry that isn't composed just of the direct manufacturing of cars and trucks, but of course, the business lines of countless downstream component manufacturers and suppliers. There is also the immediate impact of the strike on consumer spending and economic activity, as striking workers are forgoing their usual wages. It is obviously too soon. It's too soon to tell the overall impact of this strike, as well as the ongoing labor action in the entertainment industry and elsewhere on GDP or inflation. But I suspect it will become obvious in the coming months' worth of data. And while an agreement was reached to temporarily keep the federal government open and running, we don't know. We just don't know what will happen 4 weeks from now when this agreement expires. Finally, I also believe that this month's restart of student loan payments will have a dampening effect on consumer spending. How much so, however, that remains to be seen. So let's turn to the job picture. I do anticipate national unemployment to end the year around 4%, just slightly above where we are now, and to increase slowly over the next year to peak around 4.5%, before heading back to 4% in 2025. That is a rate in line with what economists call the natural rate of unemployment, or the theoretical level where labor market conditions support stable inflation of 2%. Now, before you all post, Pat says unemployment is going up on your social media feeds, let me be clear about one thing. This does not mean I expect mass layoffs. There are many factors that play into the calculation of the unemployment rate itself. For instance, we've had recent months where even as the economy added more jobs, the unemployment rate increased because more workers moved off the sidelines and back into the labor force. And beyond the hard data, I also have to balance the soft data, the things I hear. For example, employers throughout the 3rd District have told me that given how hard it has been for them to find the workers they currently have, they are doing all they can to keep them. So for Delaware, the jobs picture remains consistent. 3 straight months of labor force and household job gains has brought the state's unemployment rate closer to that of the nation than at any point in the prior 2 years. Jobs numbers in major sectors, including construction, finance, and professional services, are all above where they were in February 2020. I would also specifically note the nearly 9% year-over-year increase in jobs in the leisure and hospitality sector, and that's back to around pre-pandemic levels. Surely, the pandemic was such a large health and economic crisis that it marks a before and after in our minds and in our lives, not the least of which was the tremendous loss of life that touched so many of us very closely. We all got touched by this. It was a shock. It was a shock in every sense of the word. So to many, the new normal still does not feel normal. Again, the pandemic, I mean, this incredible tragedy we went through in many ways, it's likely to be a defining event for generations that experienced it. This is true for families and for businesses. But having said that, allow me to pose the following final thought. What has fundamentally changed in the economy from, say, 2018 or 2019? In 2018, inflation averaged almost to the decimal point 2%. It was almost 2% exactly, and was actually below target in 2019. Unemployment averaged below 4% for both years and was as low as 3.5% nationwide and in Delaware, while policy rates peaked below 2.5%. So from the cold lens of economics, I do not see the fundamental changes that would call for large changes in the natural rates. But look, I could be wrong. And trust me, that would not be the first time this economy has made me rethink some of the classic models. We just won't know for sure until we have more data to look at over time. So it is against this broad backdrop that I believe the prudent position is one in which policy rates can remain steady. Now, alas, you may have noticed that I didn't tell you how long rates need to stay high. And my apologies, because I simply cannot at this moment tell you. My forecasts are based on what we know as of today, of late 2023. As time goes by, as adjustments are completed, as we have more data and insights on the underlying trends, I may need to adjust my forecast, and with them, my timeframes. But I can tell you three things on my views on future policy. First, I do subscribe to the new moniker, higher for longer. Look, I didn't coin it, but my expectation is that rates will need to stay high for a while. Second, the data and what I hear from contacts and outreach will signal to me when the time comes to adjust policy either way. I really do not expect it, but if inflation were to rebound, I know I would have no hesitancy to support further rate increases, as our objective at the Fed is to return inflation to target, and that is simply not negotiable. Third, I believe that a resolute but patient stance of monetary policy will allow us to achieve the soft landing that I think we all wish for in our economy. So I think this is a good place for me to land my remarks so we can get the conversation. So Mike, thanks for allowing me to be here. Let's start with the Q&A. And remember, go Phillies. That's the mantra.
There you go. There you go. Pat, thank you very much for that. Let me open up with this one. And you touched on this towards the end of your comments, and it's about the workforce and kind of what the demographics look like. So we see a steady flow of retirements. I think the statistic is 10,000 people a day in this country become retirement eligible, and that's not a trend that's going to stop until 2029. High school enrollments are dropping significantly, and they really drop off nationwide in 2025. In Delaware, we only have 11,000 high school seniors this year. And so what that means for your old sector, the education sector, is a little daunting. So when you see the economy, and you consider a smaller workforce, what are you guys seeing as options? Is it AI? Is it just fewer employees? Is it better production? Federal government is going to have to meet its entitlement obligations, and what does all that mean for Social Security?
Yeah, it's a good question. So let's start with one of the basic kind of identity equations of economics, one of the basic facts of economics. Economic growth, and this is really a very simple equation, is growth in terms of productivity. That is how much we're getting, how much output we're getting per worker, increase in that, plus growth in the number of workers. In other words, there are only two things that you can do at the fundamental level to increase the overall economic wealth of the country. Let's measure that as GDP for now. Either you get more per worker, productivity, or you get more workers. That's it. That's it. So when it comes to technology, things like AI and so forth, the jury is still out on whether we're going to see a significant increase in productivity. We could. I mean, it's quite possible. There are people in the economics profession who are skeptical of that. I mean, there are skeptics. And of course, people who really believe that this is the next wave of innovation that is going to radically change productivity. My own view is somewhere in the middle. I think for certain sectors, there's clearly going to be an impact of AI. There's already been an impact of AI. I think, the chat GPTs of the world have awakened the interest across a broad community in America to what AI is, but companies have been investing in AI for quite a while. So in manufacturing, the AI techniques have been used on factory floors with the machines for quite a while now. So I think but in other areas like customer service representatives, would it replace a customer service representative? I think people are now thinking, nah, probably not. What it'll do is enhance the ability of a customer service rep and raise the average quality of those experiences we all have when we talk to a live agent. That is, the average quality of that rep will go up because the technology will help them. So there will be productivity increases. How big they're going to be, whether they're big enough to overcome the demographic shifts that you're talking about, Mike, we don't know. I mean, so that's one part of the equation, more productivity. And we've been investing in technology for a long time. I mean, we can go back to the looms in England and New England, and the productivity increase of the looms. So this has been a long trajectory of and then electrification of. It's been a long history, and those have all enhanced productivity. How much this will change, we'll see. Then there's the second part of the equation, right? The second part of the equation, more workers. And as you said, our current birth rate in the United States is not replacing us. We need 2.1, roughly 2.1 births per family, and measured as per female, typically by demographers, to replace us. Now, we're not there, and it's particularly acute in the Northeast and in the Midwest. So what do we do about that? We can either have more children, or we bring more people into the country. And here I want to double down on my disclaimer. The Fed has no say in immigration policy, and I'm not pretending to have any say in immigration policy. Be clear on this. But the raw economic fact, the basic economic fact, is that is a variable we can use. What that policy is not in my wheelhouse, not what we do. But I think that is another variable that we could use. And you look at certain states, like New Jersey, that's kind of held steady in population, as opposed to, say, Pennsylvania, where there's been some decline. Most of the holding steady in, say, New Jersey is due to immigration. And so, again, that's another variable that could be used. But clearly, and it's having a ripple effect. And we can talk a little bit about when we get to talking a little later about kind of what the Fed is up to in terms of new research activities and so forth. This is an area clearly in my old, as you said, in my old life, colleges and universities, is a significant issue for the school system, K-12 and higher education, particularly in the Northeast and the Midwest.
Thank you, Pat. That's great. I appreciate that. You mentioned manufacturing in your opening remarks, and I know that here in Delaware, a number of new entrants into the economy or some growth. And it's not, the name brands that people who've been here for generations remember, Chrysler, General Motors, but it's significant. Manufacturing here and there has been on the move and in a positive way. You guys have the Philadelphia Fed has a manufacturing index, and I see results get posted from time to time. If you could share with everybody briefly what's included in that and what's it seeking to do.
That's a good question. So we have two indices we put out, the Manufacturing Business Outlook Survey and the Non-Manufacturing Business Outlook Survey, the service sector. I'll talk about the manufacturing one. We began that survey in May 1968. May 1968. So it's one of the longest running such surveys in the country. It's a monthly survey where we go out and we survey manufacturing business leaders on their current state of their business and what they are projecting in terms of their future state. And we create what's called a coincident index. So when you look at the results of this survey, we ask people, for example, your orders, are they increasing, decreasing, or staying the same? And if you look at increasing minus decreasing and call staying the same 0, if you percentage increase, percentage decrease, that gives you a sense of if things are going up or down in terms of new orders, hiring, future orders, prices paid. So we get some sense of what we're seeing in terms of manufacturers, what prices they're having to pay for their raw components and what they're getting as a result. This survey, because it's been around for so long, is really a bellwether for, say, Wall Street in terms of getting a pulse of what's happening in the manufacturing sector. Because the third district of the Philadelphia Fed, us, the Philly Fed, we go from Johnstown, PA, roughly east in Pennsylvania, all of Delaware, and from Mercer County, think Princeton, south in New Jersey. So we're a small geographic district, but we have a lot of diversity in terms of manufacturing and also non-manufacturing jobs. We've got a lot of tourism, a lot of other industries, non-manufacturing industries as well. A lot of healthcare, which we can talk about in a bit. So it really gives us a sense, it gives me a sense as a policymaker, but more broadly, gives Wall Street and policymakers more broadly a real sense of where the manufacturing economy is, whether it's healthy, whether it's not healthy. And that kind of information shows up before we see it in the actual data in terms of productivity data and production data. So it gives us that heads up of what we're about to see in that data. It's a very good predictor. So monthly, you can sign up on our website. You can get that. We also have a non-manufacturing, as I meant, a non-manufacturing version of this. That has not as long a history. So we're still working on seeing how predictive that is of the economy, but we're getting there. And it does also seem very predictive of where we're seeing the economy going. But you're right, we're seeing a lot of diversity in manufacturing. For example, I recently took Chair Powell on a tour of York, Pennsylvania. York, for those that may know, there's a major Harley-Davidson plant there, but you'd be surprised. There's a lot of other manufacturing that goes on there beyond Harley-Davidson. Very diversified in terms of suppliers to different industries, different components. About 18% of York County's workforce is in manufacturing, whereas the national average is around 9%. So pretty heavy concentration of manufacturing in just that one county in Pennsylvania. But again, what you're saying, Mike, as you said, we're starting to see a lot more diversity of the type of manufacturing we're seeing across our district in Delaware, really across the country.
Thank you, Pat. Turning to maybe the commercial real estate sector for a moment. There's been plenty in the news about office vacancies, principally in downtown, highly dense business districts or suburban areas, et cetera. Is this cause for concern? And what are your thoughts about the vacancy rate in the commercial real estate market?
Yeah, thank you for that question. It is a concern, but I first need to parse out the word commercial real estate, the phrase commercial real estate, because we often lump it all together in one category. But you really need to really understand it, you need to disaggregate it. So there's obviously office space, but there's office space in urban centers and suburban office space. There are warehousing and logistics operations. There are doctors' offices and healthcare facilities. There's a host of different types of commercial real estate. And so while we've seen a lot of pressure on downtown office space, and I'll come back to that in a minute, some of the other areas, we've not seen the same pressure. The dentist, you still need to go to the dentist. There's no virtual dentist, so far as I can tell, right? And so we still need to go to the dentist when we have a toothache. or to the doctor, even though there's some telemedicine. So certain sectors are doing better than others. Travel and leisure, tourism. Again, much of that is you show up. So specifically, the area, for me, the real area of concern is downtown office space. We're seeing this. It varies a lot across the country, how much vacancy there is. You're seeing at sort of the high end cities like San Francisco with very high vacancy rates, others less so. Some of that is tied to return to work policies by employers in the city. For example, here in Philadelphia, Comcast after Labor Day went to 4-day a week in the office for all workers. So you are seeing different policies being implemented, and some of that is in reaction to the labor market conditions and sort of long-term development of employees. And we can talk about the hybrid work environment if you like, but it is a concern. It's a concern particularly because there is exposure in the banking sector, but there's also tremendous exposure in the non-banking sector, the financial services. So think real estate investment trust, and you can go down the list of people who have invested in these properties. So it is something we're watching very carefully because it does have potentially a large impact both on the economy as a whole and as supervisors of financial institutions, banks in particular. We are worried about, in particular, community banks who may have an outsized exposure to some commercial office space, whether that they have the proper risk management practices in place to manage those risks that are increasing. Yeah, so it's clearly an issue.
Thanks very much for that. Let me remind all of our participants today, they're welcome to put questions in the chat, and I'm going to go ahead and read one of those now.
Sure.
This comes from Wayne Smith, who you may remember. Our federal debt exceeds $33 trillion. What will the effects be of this growing debt, and when will they start to be felt in the economy, beyond just what the interest rate or interest portion of the federal budget and that growing?
Yep. So let me triple down on my disclaimer.
All right.
All right. So the deficit is not something that the Fed has a direct impact on. Of course, Congress and the administration and the White House, that is their purview, the federal purse. But the question, when will it be impacted in the economy? It's a good question. It's hard to get a specific answer, but I'll give you, at least point you in one direction where I think there are some answers. So one of my old colleagues from my days at Wharton, a guy named Kent Smetters at the Wharton School, runs a project called the Penn-Wharton Budget Model. It's a very good model, and I would encourage you to look at it. They put out a recent report on this very question of when is the tipping point where, without either significant budget cuts or increases in revenue, we have a real problem with the deficit. And by the way, I'm going to editorialize again. This is Pat, not the Fed. Let me be clear. There was this view for a while when interest rates were essentially zero, that debt was free, and that we could just load up on debt. And there's something called modern monetary theory that said, why not just load up on debt because the money's free? Well, it's not anymore. And so if you look at the federal budget, there's a significant increase in debt service costs because rates have gone up. And so that is putting real pressure on the budget. But Kent has, and his team have put out a couple of analyses on when is a tipping point where this becomes a real issue. It's not that far off. I mean, the point is that they make, and you can look at this for yourself, that it's not right around the corner, but at the same time, it's not, a next generation problem. It's our problem, and we need to deal with it. And here, and now quadruple on my disclaimer, you step back, and I step back as, I'm an engineer by training, engineer economist, and I'll put my engineer hat on for a minute. Just look at the raw numbers, just dispassionately. What is the federal deficit? What is our significant? It's defense, entitlement, and interest on the debt. Those three comprise 70+%, almost 80% of the US budget. That's it. Defense, entitlements, interest on the debt. We talk a lot about the other 20%-ish, but the reality is, unless you deal with entitlements, the interest on the debt, which is borrowing less over time, and defense, and or increase revenue, you can't get this under control. That's where the conversation has to go. And what's frustrating to me personally is that things get lost in the weeds. We get lost in the weeds around this question, where we should be, it's the old Pareto's law, the 80-20 rule. It applies here. 80% of the issue is on those three things plus revenue, not the 20%. That's where we need to have, we as a community, we as a country have to have that conversation.
Appreciate that. That's helpful. Thank you. I've read news reports where the Fed staff in Washington has said they do not expect a recession in 2024.
Right.
And that differs with the view of some economists from some of the banks in particular.
Yeah.
So can you kind of help sort out the differences of opinion? Can everybody be right or can everybody be wrong?
Yes. So again, my view is that we don't anticipate a recession. Look, there's always a chance, always a probability of recession, always, right? And it's never zero. The question is it elevated beyond what you would normally expect? Our models right now, it's slightly elevated, but not to where we would think a recession is probable. Most likely. It's not. We just don't see it right now. Others will look at the same data with different models, with different lenses, and maybe come to a different conclusion. But at this point, we think that this soft landing we've been talking about is quite possible. In fact, that's our modal forecast. That's what we're expecting. And I think what you're seeing, particularly from Wall Street forecasters, is they are getting more and more in line with that view. Now, there's a huge caveat to this, huge, that we've been hit time after time with shocks. The proverbial black swans, as they've been called. Things that come out of left field that we don't expect. I mean, this tragic war in Ukraine, now this horrible situation we're seeing in Israel and the Middle East more broadly. And whether that grows and whether that has an economic impact more broadly across the global economy, energy markets, et cetera, we just don't know right now. We just don't know. But given what we know today, I think we're not expecting a recession. But again, these things can hit us. And they have hit us. I mean, the pandemic. I mean, you think about all the things that kept hitting us time after time. What is remarkable to me, Mike, is that despite all of that over the last few years, everything we've been through, everything that's hit us, this economy has remained pretty resilient. I mean, we've remained pretty resilient. The businesses that are, represented on this call, in this meeting, you've been creative. You've worked hard to figure out how to deal with what's been dealt to you. And so you deserve tremendous respect for what you've done, because that's what keeps the economy chugging. Business after business, leader after leader, figuring out, okay, this thing has happened to us. How are we going to deal with it? How are we going to make this work? And so I just applaud you, because it's been quite remarkable. That to me gives me hope and optimism that I don't see, if another thing hits us, we'll probably work through that one too.
Appreciate that. Thank you. From the chat question, when you look at and kind of factor in your decision on the FMOC about raising rates or not. You prefer core CPI data or CPI data to influence your decision?
Yeah. So our preferred measure in the FOMC is actually PCE, personal consumption expenditure. It's slightly different. So what's the difference between CPI and PCE? Especially the same components of goods and services that are consumed with slightly different weights. One weighs one thing like shelter a little more than the other. And so our preferred measure, because we over time think it's a better predictor of the economy, is PCE than CPI. But the two are related. They're not they're never really the same, exactly the same, but they're related. We definitely prefer core to headline because energy prices bounce up and down a lot. Food prices bounce up and down a lot. What we're trying to look for is what are the underlying pressures on the economy? I mean, what's really driving costs? So in addition to the core PCE number that we look at, and we look at the CPI numbers and other numbers as well, what I like to do is not just look at the number. The number tells you something, but what I like to look at is the distribution of inflation. What do I mean by that? So if you lined up, all the goods and services in the economy and said, how many are experiencing inflation that's above, let's pick a number, 5%? How many are 4.5%, 3%, et cetera? Let's line them up. Early on in the pandemic, what we saw is just a few things were increasing. Used cars, if you remember, we talked a lot about used cars. But then what we started to see is that started to spread. More and more goods and services started to see increases that were pretty large. And that's why we early on got off the transient view that inflation doesn't seem so transient, that it's going to be more persistent. So what we're really focused on right now, what I'm focused on right now, is looking at that same data and seeing how many things are starting to come into the 2% bucket, the 2.5% bucket, starting to move toward 2%. So again, it's easy to try to pick one number to summarize what's going on, but it's better we look at a myriad of measures. And in addition to the inflation number, one of the areas we're trying to do is predict where inflation is going to be. And a good predictor of that is wages. And so we particularly watch wages in what we're calling core services, or some people call super core. As you take shelter out, we know where shelter is going, by the way. We can talk about housing. But you look at the prices, what firms in the leisure and hospitality industry have to pay for workers and other kind of services, healthcare. Those numbers are starting to come down. But given that you take a typical industry like leisure and hospitality, right? 70% of their cost of running their business-ish is labor. So if they're seeing big wage increases, you're going to see a lot of inflation. That we try to watch very carefully is the wage data as well. And we're starting to see that move down, but we need to see continued movement down, be confident that inflation is moving in the right direction.
Very good, thank you. Speaking about consumers for a moment, several reports have come out recently on the subject of consumer debt, whether it's, and you made mention of this in your opening remarks, credit card debt. There's a story, I think Monday or maybe over the weekend, on buy now, pay later contracts and how late pay data is starting to inch up consumers. Any thoughts, concerns about that trend?
Yeah, so one of the areas of Philly Fed, because of the Delaware footprint in the credit card industry, one of the areas we've developed over decades is it started off with something called the Payment Card Center, really understanding the payment industry, the credit card industry. We've really grown that over time to something called the Consumer Finance Institute, where we really try to understand in a great level of detail what's happening with the consumer. And in addition, the stress test, the CCAR for the large banks in the country that the Fed runs, we in Philadelphia develop, manage, and run the stress test models on the consumer portfolios of the major banks in the country. So again, we have great expertise in things like auto lending and mortgage lending and so forth. We are starting to see an uptick, say take auto for instance. We are starting to see an uptick in some default rates. It's not really of major concern right now. It's kind of moving back to where we were pre-pandemic, but the trajectory is moving pretty quickly. So whether that levels off or not is something we're very, very carefully watching. It hits first, obviously, people who have subprime credit ratings, but it's starting to inch into other places. In particular, we're trying to watch the impact of the student lending, having to pay back the student loans. Is that going to have an impact on people's ability to pay other bills, like their auto bill, for instance? So we don't know yet, but it's clearly something we're watching. We're starting to see some early signs of concern. And I know the banks are also starting to see some early signs of concern. They don't have real, it's not a worry yet, but it is something they're watching as well.
Thank you for that. Thank you. A question from the chat: as median home prices rise, how serious is the housing affordability crisis in your mind on the development of workforce and household financial security? We actually just had a conference, Pat, earlier this month, where we talked about how Delaware has an abundance of single-family detached homes and not enough diversity in its offerings, multifamily, duplexes, etc. Sussex County, 85% of the housing units there are single-family detached. So to the questioner's question about median price.
Yeah, I mean, again, it's a real concern, and particularly in certain areas. I mean, look in geography by geography, you have to break it down because some areas less so than others. For example, here in Philadelphia, we have a lot of multifamily units coming online here in the next few years. So that will have an effect of starting to stabilize rents, if not even bring them down. So there's a real significant number coming on. That's not true in other markets, like you're saying, in Sussex County. The concern right now is for single family, you have this lock-in effect, right? Where I'm sitting on a 3% mortgage and I'd like to move out of my starter home to the next home, but I'm not paying the current mortgage rates to do that. So I'll sit. So that first-time home buyer can't get into the market. We're hearing this from the banks, our banking contacts, that particularly for first-time home buyers, there is simply no activity going on for mortgages. They're just not seeing anything. And that a lot of that is inventory. And so that has an effect of raising prices. And that has an odd effect, right? The normal thing we think about in monetary policy is if we increase the cost of money, that is the interest rate, that should dampen demand for interest-sensitive industries. And that's starting to work in the auto industry, for example. Auto sales have leveled off a bit, depending where you look. But what's starting to happen is, just like with used car prices, if nobody's buying a new car, there's no used cars, so those prices go up. Same thing's happening in the housing. If people aren't going up to the next house, they're not selling their current house, so those prices go up. So it has the opposite effect of what we want, is to see prices coming down. So this is where I'm very cautious about raising rates more than where we are. In fact, again, I'll never say never, but at this point, I think holding is better than continuing to raise rates, because we're hearing just a lot of other effects like the housing market that we have to be worried about.
Thank you. A big piece of the Delaware economy and frankly, the U.S. economy is the small business sector,
Absolutely.
right? And you guys have a small business lending report that you do, and we work in coordination with your team to produce that every year. 57,000 licensed businesses in the state of Delaware, 56,000 by SBA definition are small. Can you share with our listeners the importance of that lending report and what it is you hope to gain from the insights that come from it?
Yeah, so if we look at the national level, you gave the Delaware numbers, over 99% of businesses, registered businesses in the country are small businesses by definition, right? That employ roughly half the people in America. But you think about the size of these, about 80%, 8 out of 10, have no employees. They're just family-run businesses. And the rest are small, 1 to 19 employees generally. So these are the lifeblood of the American economy, right? These are the ones that really we have to keep our eye on, and the health of that sector, because of just the sheer size of that sector, and how important it is. And we're starting to see, one of the growth areas we're starting to see a lot in that sector right now nationally is in home health and personal care kind of businesses. So as we age, that makes sense. I mean, I'm a boomer. Someday I'm going to be taking more advantage of that. I know there's others on the call like that. So that survey gives us a real sense, right? Gets the pulse of what's happening in that sector. And because it's just the sheer size of it, we really need to really need to understand it. So I appreciate the work that you and the chamber do in supporting this survey, because without it, we'd be in some ways flying blind and not really understanding what small businesses are facing. So thank you and for those who are on in the meeting, thank you for participating if you get asked. I really appreciate it.
Thank you, Pat. We've got just a couple minutes left. I'm going to mention, I've got time for one more question from the chat, and then I'm going to mention some upcoming events very briefly, Pat, and then I'm going to ask you a final wrap-up question as to maybe describe some of the research projects or things that you may have in the cooker upcoming. But another question from the chat, it's almost is more on the side of personal financial advice, but as a boomer myself, this one is top of mind for people like me as well. And the question is, do you think people nearing retirement age should consider postponing retirement? And come to the issue from another angle, there appear to be many people who can't seem to let go of their jobs for whatever reason. Person says, parentheses, hello, Congress, and from the standpoint of the economy, should people keep working?
Well, if you ask employers right now, and particularly in skilled positions, if you're a machinist, they want you to keep working for 2 reasons. One, they need your skills today, right? And that's true throughout, if you're a nurse in particular. I mean, with the dearth of nurses in the economy right now, I mean, that number is very significant. We're looking at a huge missing piece of the healthcare industry in nursing right now. So if you're a nurse, they want you to keep working. But it's not only that you're doing the job, but you're training the younger people coming behind you, right? So I can't tell you personally what you should do or not do, but I can tell you, at least from every business I've talked to, if you pose that question to business leaders that I've met, they'd all say, yeah, just please keep working, because we not only need your skill today, but we need your knowledge of training the workforce of the future.
Exactly. Another one that just came in from the chat. How does the Federal Reserve view the current wage growth trends and their implications for overall economic stability and consumer spending?
Yeah, so in terms of wages, we saw a big increase in particularly the lower deciles of wages, that is the lower income, lower wage jobs through the pandemic. That's starting to level off. That gave that sector of the American consumer the money that they needed for their families. That's starting to level off. We are starting to see wages, while still elevated, starting to come down. We look at that through the lens of what that means for inflation. I talked about that earlier, and obviously what it means for consumer spending. 70% of gross domestic product is consumer spending. So when the consumers stop spending, our growth slows down. So clearly we care about this. It is starting, we want it to cool some, but we don't want it to fall off the cliff. And this is where we think this is part of the soft landing. We want it to cool back to where we think wages should be in terms of, there's a relationship between wages and having 2% inflation. Wages can be higher than 2%. Here's the basic math. If you take inflation plus productivity, that should be roughly what wages are. So that would be the kind of equilibrium in the economy. We're not there right now, but it's something we're watching. Yeah.
Thank you very much. Pat, I may mention a couple of upcoming things that we've got, and then I'll ask you to sum up with some projects and research
Sure.
work that the Fed may have underway. We've got, speaking of small businesses, we have our 25th annual Superstars in Business Awards coming up on Wednesday, November 8th at the Hotel DuPont. Our keynoter will be Brian DeSabatino this year. We have a networking breakfast on Wednesday, the 15th at the Biggs Museum. Our Chamber Leadership Breakfast, one of my favorite events, is going to be Thursday, November 30th, and our guest speaker is going to be somebody Pat's familiar with. It's going to be Marvin Skip Shaneholtz, who's going to talk about his journey. And finally, our annual dinner has been pushed a little bit later this year. Insight Corporation is going to be our presenting sponsor. The annual dinner this year will be January 29th. That's a couple weeks later than typical. And that'll make everybody who's interested in watching the NCAA football championship game a little happier, since we won't conflict with that. So, Pat, thank you again. As we wrap up, what research projects or interesting work does the staff, your team, who we enjoy working with, what do they have underway that might interest everybody listening this morning?
So I mentioned two things, and I encourage you to go to our website and look these up. One is reinventing our communities. We have what we call ROC, or Reinventing Our Communities cohorts, working with communities around the country on issues of economic development that they face, and really that we think can be national models. So we've done work in Delaware before on childcare. We've done some work in other places in Delaware, and I encourage you to take a look. The other place I can encourage you to look is, and there's lots going on, I really encourage you to come to our website. But the other area that is, I think, of real interest to me, and I think to the region as a whole, is around eds and meds. That is the future of educational institutions and healthcare institutions. And we have what we call the Anchor Economy Initiative. And we call it the Anchor Economy because typically these eds and meds, they are fixed in place. These are really the anchors of the regional economy, the local economy. And they're under stress, as we talked about, with the changing demographics. Education is under stress. Healthcare is under a lot of stress with the cost issues. So we have a database you can look at in 524 regions in the US. So for example, you can go in and compare and contrast our regions here relative to other regions around the country to see what are our strengths and our weaknesses in this area. It's a growing area for us. And in addition, we're doing work on higher ed finance and student lending, understanding the health of higher education institutions because they're so important to our region in particular. So again, the Anchor Economy Initiative, our ROC cohort program, and lots of other things going on in the Philly Fed.
Pat, thank you kindly for spending this hour with us again today. We really enjoy it. Our members value it highly, and you're great to do it. And so thank you very much again. We enjoy working with your team, and we're grateful for their work with us and different important initiatives that really impact our economy here in Delaware, but also in the region. So thanks everybody for joining us. We visited with Pat Harker, president of the Philadelphia Federal Reserve Bank this morning. Have a great day.
Go Blue Hens.
Take care, Pat.
Thank you.